So understanding assets, basically an asset is anything that you have that if you closed your business today, you could either use for cash or sell for cash. So we have current assets. That's anything that's going to be used within a year. So that's cash. The money that customers owe you is called accounts receivable. So let's say you performed a haircut and you were like, hey, you can pay me back in 2 weeks, that sort of thing. Well, you perform the service, so you've earned the revenue, but you haven't actually received it yet. So you put that in your accounts receivable account. And then when that customer pays you, the accounts receivable balance goes down. So another current asset would be inventory or prepaid expenses. Like let's say you paid a whole year's worth of rent upfront. That's actually an asset in this case because it's not something that you have to expense every month. So you would actually create a journal to reduce your prepaid rent balance and increase your rent expense balance. Let's say you paid 15 grand for rent in January or something like that. And you're like, I'm going to pay for X number of months. If you were just looking at your books, you'd have this $15,000 expense that would completely throw off the business performance. So it's in an asset account, and then you actually observe that expense over time. And then a fixed asset is going to be like a long-term physical item. So that's like equipment that you're going to be using for years, furniture that you're going to be using for years. If you had a vehicle or if you owned your own building, those would all be fixed assets.
Cool. But that's stuff that can still depreciate.
Mm-hmm.
Yeah.
Yeah. So other accounts, liability accounts, we talked about those before. So that's money that you need to pay someone else. So we have short-term and long-term liabilities. So short-term, we've got accounts payable. So if you're like, you bought a bunch of product and they're like, hey, we'll give you 30 days to pay on it. When you purchase that, you owe them, let's say, $3,500. Your accounts payable increases $3,500 because you owe that money.
Mm-hmm.
And then when you pay it, it will decrease back down. Sales tax payable, we kind of talked about that. Like you collected it and it accrues over time. And then at a certain point, you owe it to the government. So you have to do your tax filings. And then your tips are another liability account where you accumulate them because you receive them from a payment and then a customer payment, and then you are liable to pay out the stylist. So long-term liabilities are money that you'll pay back over years, multiple years. And this basically just shows like when you look at your business, you know what's going on. So when we look at our personal finances, we don't typically see somewhere where like rent bill is due later on, or we don't see like the phone bill is due later on. We just sort of like have to keep track of when those things come due, right? In a business, when we look at the business, we can actually see everything that a business owns and owes at the same time. So if you have $20,000 in assets and you have $120,000 in liabilities, you're not in a very strong financial position. So we can basically interpret the reports that we'll look at later on to see like what is the financial health of the business. All of this stuff is going to be really important because you might have an investor, or even if it's the SBA and you go in for an SBA loan, they're going to be like, hey, what's your accounts payable balance for this or whatever? And you're like, I don't know what the fucking accounts payable is, or like, I don't even know how much I owe on something over a period. If you don't have those numbers listed anywhere, who has confidence in, taking you on? Because they ultimately, as investors, become liable for your debt. So I'm going to have a master cut of Dawson yawning during this.
I've only yawned once.
So our equity accounts are basically like what you own as the business owner. So basically you own...
Should have said yawn.
You own the assets minus the liabilities. Your asset investments, so that's anything that you've contributed that's material to the business. So an example is like the cameras or whatever. Like I purchased and I capitalized the business with them. So the value of those cameras goes into my capital account because they are 100% for use for the business. And then there's cash investments too. So like when I opened my business bank account, I transferred a bunch of money into it so the business would have operating capital. I still have that much value in the business because that's how much I contributed to the business. So I contributed both assets and cash into my business. And I think you guys, Ryan, you did the same last year. You put actual cash into the business, right?
Yeah.
Okay.
Mhm.
So you did that, and then you also like purchased things that you would need, and then you capitalized the business with that too. So your salon chair and scissors and stuff like that. I think you even made some product early like inventory purchases
Mhm.
too, right?
Yeah.
All of those are increasing your capital balance in the business. Now, if you were to take money out, so as you paid yourself overtime last year, took an owner draw, which means that you removed that value from the business. It's no longer circulating inside of the business ecosystem, and that entire value of the business starts to shrink as you pull those out. One thing to note is that a draw is different than a salary. We kind of talked about this with S Corp stuff, but a draw is you claiming your share of the profits of the business and taking money out. And a salary is a payment for work performed. If you elect S Corp status, then you will pay yourself a salary as well. And that will be for the work that you perform. And the money that you take after that will be the profits, and those will be draws. Or if you're an S Corp, then that would actually be called a distribution.